It is Wednesday, and that means it's time for Mike on the Money. Mike Giordano, financial advisor with Williams Wealth Management, is joining us this afternoon. And Mike, today we're talking about international investing.
Are you going to be speaking in a different language?
Not this time.
Please don't do that.
No.
John Oliver will put us right back on HBO, make fun of us and everything else.
We'll speak English for this. But talking about international investing, why should we even consider investing in companies that are outside of the United States?
That's a great question. A lot of people ask that because the U.S. markets have dominated the international markets since basically the financial crisis. And so people are like, why would I invest overseas when I'm getting better returns here in our home country? But the big thing is you got to widen out your view a little bit. And if you look at the first decade of this century, it was much more favorable to be invested overseas. So when you take a broader view, the reason why you want to invest in international markets is for diversification.
Taking a look at those international markets, they're both big and small, developed and emerging. So how do people choose?
Yeah, that's true. So yeah, you have dozens and dozens of countries, and some of them are small countries, and some are real fast-growing countries, and other ones are more mature and stable. You think like Japan, you think Europe, you think Australia and Canada. Those countries don't grow as fast, but they're also much more mature, and so you get that stability. On the flip side, those emerging markets are growing a lot faster, so you might be able to pick up a little bit more return over time, but you're also going to maybe deal with a lot more roller coasters. So you just have to decide, what kind of investor you are.
All right, so how much of our portfolio should we consider investing overseas?
That is the big question, and there's no one size fits all for everybody. It really comes down to your risk tolerance because, as I mentioned, sometimes overseas markets can be a little bit more volatile, especially those smaller countries, and you might not be as familiar necessarily with what's happening in those countries. Are they heading into a recession? Are they coming out of a recession? So it's really difficult to figure out how much money you want to put in, but generally you're taking a look at how much money do you put into your growth assets like stocks, and then it's not uncommon to see 10, 20, 25% allocated towards international investing. But again, those are just kind of guidelines. It really comes down to how your personal preferences are.
Okay, so help us get started. What are some easy ways to start investing internationally?
Yeah, so the good thing about this is it is relatively easy. We're not talking about going to like Rome or Tokyo or Beijing to go invest, although that would be fun. And we should take the segment over there. That would be awesome. I'm not sure the budget's there for that, but nonetheless, very easy ways. So we're talking about companies that are listed in U.S. markets. So you can buy those companies as individual companies, or if you don't really want to do the time and take the time to research companies, you can also invest through funds, ETFs. And likely a lot of the viewers probably already own these things within their 401ks. You have funds within your 401ks that are international funds, and they're labeled as such. The other thing you have is these retirement dated funds. So you think a 2035 fund, a 2040 fund. Those things are going to have a lot of U.S. stocks in them, but they'll also have some international exposure.
Great advice. As always, Mike Giordano, financial advisor. Let's head. Where should we go? Italy? France?
I don't know. I have not been to Paris, and you've raved about Paris, so maybe we should do that.
But not speaking French on TV. We've learned our lesson. Mike, good to see you.